Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Shenhua Energy Company Limited annual report. And China Shenhua Energy Company Limited is a diversified conglomerate with a wide range of businesses and services. At its core, the company engages in the production and sale of coal and power, making it one of the leading energy companies in China. In addition to its coal and power operations, China Shenhua also provides transportation services through its railway, port, and shipping segments. The company's railway operations offer a convenient and efficient way for goods to be transported across the country, while its port operations provide loading, transportation, and storage services for cargo. Meanwhile, its shipping operations enable the transportation of goods by sea. The company's diversification extends beyond energy and transportation to include coal-to-olefins businesses. This segment produces a range of chemicals, including methanol, polyethylene, and polypropylene, which are used in various industries such as manufacturing and construction. Overall, China Shenhua Energy Company Limited is a multifaceted company with a broad portfolio of businesses and services that cater to the energy, transportation, and chemical needs of its customers. China Shenhua Energy Company Limited market capitalization of 1,101 billion is significantly larger than the average industry peer of roughly 2 billion. This shows that China Shenhua Energy Company Limited holds a significant advantage in their industry. China Shenhua Energy Company Limited trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.93 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 23% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 7.63%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified by analyzing the data presented in the extracted summary. In terms of segments, the coal segment experienced significant declines, with an 18.2% decrease from RMB 223,409 to RMB 182,874, and a 36% decrease from RMB 63.213 million in 2024 to RMB 40.271 million in 2025. On the other hand, the power segment saw growth, increasing by 7.3% from RMB 95,769 to RMB 88,914. The railway segment experienced a remarkable 100% increase from RMB 1796 to RMB 2385. However, the shipping segment declined by 8.5% from RMB 11,120 to RMB 12,409. At the company level, China Energy Sales Group Co., Limited, and Zhengzhou Energy experienced revenue declines, while China Energy Jinji Energy Co., Limited, and Yunhai Shipping Co., Limited, saw decreases in revenue. In contrast, Huanghua Harbor Administration Co., Limited, reported an increase in revenue from RMB 5188 to RMB 5388. Looking at the overall trend, the data suggests that there was a significant decline in revenue growth between 2024 and 2025, with a decrease of minus $45,872 million, minus 13.46%. This indicates a downward trend in revenue growth over the past few years, with some segments and companies experiencing more pronounced declines than others. The changes in net income and profit margins over the past year have been significant. Initially, net income decreased by 12.6% due to a decrease in power output dispatch and average price of power sales. However, this trend was reversed as net income increased by 3.2%, followed by a substantial increase of 25.7%. The latter can be attributed to an increase in transportation turnover of self-owned railway and loading volume on port. Profit margins also underwent changes, with some segments experiencing increases while others decreased. In the coal segment, profit margins decreased by 1.7 percentage points due to lower output and sales volume of polyolefin products. However, other segments such as power generation, port, shipping, and coal chemical saw an increase in profit margins. The reasons for these changes are varied. For instance, the decrease in net income was partly due to a decline in purchase cost of coal. Conversely, the increase in transportation turnover of self-owned railway contributed to higher net income. Additionally, the coal chemical segment experienced a 10.9% year-on-year increase in coal consumption, which positively impacted profit margins. Overall, the fluctuations in net income and profit margins can be attributed to a combination of factors including changes in power output dispatch, average price of power sales, transportation turnover, and coal consumption. The company's operating cash flow is a crucial indicator of its financial health. According to various sections in the report, the company is indeed generating positive operating cash flow. On page 9, it is stated that the net cash generated from operating activities is RMB 93,348 million. Similarly, on pages 247 and 317, it is confirmed that the company has a positive operating cash flow. The data provided on these pages shows that in both 2024 and 2025, the company's net cash generated from operating activities is positive, ranging from RMB 75,059 to RMB 109,826. This suggests that the company is able to generate sufficient cash from its operations to meet its financial obligations. However, there are some discrepancies in the report. On page 293, it is stated that the operating cash flow is negative, which contradicts the information provided on other pages. Nevertheless, the majority of the data points indicate a positive operating cash flow, suggesting that the company's financial situation is stable and healthy. And the company's debt level has undergone a significant change in the past year. Initially, it was reported that the total debt level decreased by RMB 14,085 million from RMB 50,285 million to RMB 36,200 million. However, this trend is not consistent across all periods, as another report shows an increase of RMB 56 million from RMB 5,358 million to RMB 5,414 million. On the other hand, interest expenses have consistently decreased over the past year. The data indicates a decrease in interest expenses by -605, -19.8%, from RMB 3073 in 2024 to RMB 2468 in 2025. Additionally, there are two more instances where interest expenses decreased by RMB 568 million and RMB 165 million respectively. The overall trend suggests that the company's debt level has changed significantly, with a notable decrease of RMB 14,085 million. However, the decrease in interest expenses is also substantial, amounting to around RMB 1 billion or approximately -19.8% from 2024 to 2025. The company's performance varied across different segments and regions. On the positive side, power generation, port, coal chemical, and shipping segments all showed significant improvements. The power generation segment saw a 1.8 percentage point increase in gross profit margin, while the port segment experienced a substantial 6.5 percentage point boost. Coal chemical also reported a notable 1.7 percentage point rise in gross profit margin. Meanwhile, the shipping segment achieved a reportable segment profit of 13,012 million RMB in 2025. However, some segments struggled to keep pace with the company's overall growth. The coal segment suffered a decline in gross profit margin by 15.9 percentage points, indicating a significant setback. Additionally, the railway segment experienced a substantial drop in reportable segment profit, decreasing from 11,353 million RMB in 2024 to 2,659 million RMB in 2025. Furthermore, the port segment's reportable segment profit also declined, albeit slightly, from 260 million RMB in 2024 to 269 million RMB in 2025. Management is emphasizing the importance of prioritizing high-quality development as the company's primary mission, with a focus on sustainable growth and overcoming market dynamics challenges. To achieve this, they are implementing new strategies such as 4 revolutions and 1 cooperation for energy security, and 1 plant, 1 policy to strengthen electricity and heat supply guarantees. The company is also shifting its focus from being large and comprehensive to becoming strong and excellent, with a transformation towards green and low-carbon energy. This includes accelerating green development and carbon reduction, innovation-driven development through technological innovation, and strengthening capital operations as an investment and financing platform. In terms of investment plans, management is focusing on expanding effective investments while strengthening planning, leading, and directing control efforts to cope with investment risks. They are also improving the investment management system and adhering to strict checks throughout the process. Furthermore, management is emphasizing sustainable development and continuously evaluating operating performance to ensure long-term success. This includes enhancing capital strength, improving financing and fund management efficiency, and increasing investment returns through joint external investments. Overall, the company's strategy is centered around achieving sustainable growth while transitioning towards green and low-carbon energy. The company has a history of paying dividends to its shareholders. This practice is confirmed across multiple pages in the financial reports, including page numbers 2, 14, 39, 143, 145, 147, 149, 150, 225, and 303. The consistent payment of dividends indicates a commitment to returning value to investors. That concludes the financial summary for China's Shenhua Energy Company Limited. Feel free to comment below, and I will be happy to answer them when possible.